Hey everyone, and welcome to our deep dive into primary markets. This is an absolutely crucial chapter if you're prepping for your NISM Series 12 exam. If you've ever been curious about how a company goes from being private to being listed on the stock exchange for everyone to trade, well, you are in exactly the right place. We're about to break down the entire process.
So, here's our game plan for today. We're going to start with the absolute basics. What even is a primary market? Then, we'll meet the mission control team, all the key people and firms that make a public issue happen. After that, we'll look at the different ways a company can issue securities and, importantly, how they figure out the price. We'll walk through the entire step-by-step process of a public issue, and then we'll wrap up with a quick exam checklist to make sure you've got the most important points locked in.
All right, let's kick things off at the very beginning. What exactly are we talking about when we say primary market? You've got to get this concept down cold because everything else builds on top of it. This is ground zero for any company looking to raise public money to fund its big ideas.
Okay, so imagine a factory, but instead of making cars or phones, this factory creates financial securities, like stocks. That's the primary market. It's where brand new securities are born and sold for the very first time. Now, the most important part to remember here is the flow of money. It's a direct line. When you buy shares in an IPO, your money goes straight into the company's bank account. They then use that cash to build new facilities, hire more people, or expand.
This slide really nails the difference with a great analogy. The primary market is like the brand new car showroom. The company sells you a shiny new car and they get the money. Simple. The secondary market, that's the used car lot. That's where you sell your car to somebody else. The original car company isn't involved at all. It's the exact same with stocks. The secondary market, think the BSE or NSE, is where investors just trade existing shares among themselves. The company gets zero cash from those trades.
You know, a company can't just decide to go public and do it all by themselves. It's a massive undertaking. It takes a whole team of specialists, our mission control, to make sure the launch is a success. So, let's meet the key players who get this job done. And here they are, the core members of that mission control team. Now, what's super important to remember is that every single one of these intermediaries is registered with and regulated by SEBI, the Securities and Exchange Board of India. This is a huge deal because it ensures the whole process is fair, transparent, and that investors are protected.
Okay, so leading the charge is the merchant banker, who you'll often hear called the book running lead manager, or BRLM for short. Just think of them as the mission director. They are in charge of the entire operation, from start to finish. They help decide the best time to launch the IPO, they figure out the pricing, and they handle a mountain of regulatory paperwork.
So, if the merchant banker is the director, then the registrar and transfer agent, or RTA, is the logistics commander. These guys handle the incredible task of processing potentially millions of applications, figuring out who gets shares, and making sure everyone who doesn't get an allotment gets their money back right away. It's a massive administrative job, and it's absolutely critical. All right, so we've met the team. Now let's talk about the different kinds of missions they can actually go on. A company has a few different options for raising capital, and each one is designed for a different goal.
As you can see, it's not a one-size-fits-all situation. A company can go for a public issue, which we know as an IPO if it's their first time, or an FPO if they're already listed. Or they could do a private placement and just sell to a few big investors. They can also reward their current shareholders with a rights issue or a bonus issue. Now, for your exam, we are going to focus almost entirely on the public issue, and specifically the IPO.
You know, an IPO is a huge deal for a company. It is a massive, transformative event. It's the moment they go from being a private club owned by a handful of people to a public company whose shares can be bought by absolutely anyone on a stock exchange. It's a huge step up in terms of transparency and public scrutiny.
Okay, this is a really critical point, especially for the exam. An IPO can be a fresh issue, which means the company is creating brand new shares to sell, and all that money goes straight to the company. Or it could be an offer for sale, or OFS. This is where existing owners, like the founders or early investors, sell their personal shares to the public. In that case, the money goes to them, not the company. Very often, an IPO is actually a mix of both.
So this brings us to one of the biggest questions, right? How in the world do you put a price tag on a share of a company that has never been traded publicly before? It's a huge challenge. Let's look at the main way it's done today.
Now, there is an older fixed price method, but the far more common approach these days is what's called the book building process. And it's really a process of price discovery.
Instead of the company just declaring a price, they set a price range or a price band, and then they let big investors bid. This lets the market itself decide the final price based on actual demand. It's a much more dynamic way of doing things.
Let's make this real with an example. Check out this table. Let's say our company wants to sell 5,000 shares. You can see the bids coming in at different prices. At 144 rupees, there's demand for 1,000 shares. At 140, another 1,500 shares. We keep adding up the demand as we go down in price. And boom, at 135 rupees, the cumulative demand hits 5,000 shares. That's our magic number. The issue is fully subscribed. So 135 rupees becomes the final cutoff price for everyone.
Okay, let's pull back the camera now and look at the whole shebang. The entire launch sequence of a public issue, from start to finish. This isn't something that happens overnight. It's a very carefully planned, step-by-step process that's heavily regulated.
So here's the journey. It starts internally with approvals and hiring, that whole mission control team we talked about. Then comes the really big one, documentation. They prepare something called the Draft Red Herring Prospectus, or DRHP. I mean, this document is a beast. It has everything you could possibly want to know about the company, its business, its finances, all the risks. Once that's filed with SEBI, the marketing roadshow begins. Then the issue opens for bidding, and finally, we get to allotment and the big day, listing on the exchange.
All right, let's talk about ASBA. This is a game changer for investors, and something you absolutely need to know for the exam. It's the only way you can apply for an IPO now. And the beauty of ASBA is that when you apply, the money doesn't actually leave your bank account. It just gets blocked. And you keep earning interest on it. If you get allotted shares, only then is the exact amount taken out. If you don't, the block is lifted instantly. It's made the whole process so much faster, safer, and more efficient for investors. We have covered a ton of ground, so it's time for our mission debrief. Let's really lock in what we've learned by looking at a few questions that are very likely to pop up on your exam. I'm going to pose the question, you think about the answer, and then I'll reveal it. Ready?
First one up. This gets right to the heart of why an IPO is happening in the first place. What is that key difference between a fresh issue and an offer for sale? Think about it. Where does the money go?
And there it is. In a fresh issue, the company gets the cash to grow. In an offer for sale, existing shareholders are the ones who get the money. This is why it's so important to read the IPO document. You want to see if the company is raising money for its future or if early investors are just cashing out.
Okay, next question. SEBI has a really important rule to protect investors from a failed issue that doesn't get enough interest. What is that minimum subscription level that an IPO must hit to be successful?
The magic number is 90%. An IPO has to get bids for at least 90% of the shares on offer. If it falls short of that mark, the whole thing is called off, and every single applicant gets their money back. It's a critical safety net for investors.
And for our last question, this one is all about making sure the people who run the company, the promoters, have enough skin in the game even after they go public. What's the rule about their contribution and how long they have to hold their shares? The two numbers you absolutely have to remember here are 20% and 18 months. The promoters have to hold at least 20% of the company's capital after the IPO, and they are not allowed to sell those shares for a period of 18 months. This lock-in ensures their interests are aligned with all the new shareholders. So there you have it, a complete fly-through of primary markets. I really hope this explainer has been helpful. Keep reviewing these key ideas, and you're going to be in great shape for your exam. Best of luck.